Private equity operates behind the scenes of some of the biggest business deals in the world, but the mechanics are simpler than they appear. Private equity is one of the most powerful financial models in the world, and most of its returns come from how deals are structured. This is Money Mechanics. Today we're breaking down how private equity really works, and why leverage is at the center of it. Private equity firms don't just use their own money. They raise capital from investors, pension funds, institutions, high net worth individuals, then they combine that capital with debt, a lot of debt. This is called a leverage buyout. It means buying a company using borrowed money. In many cases, the firm only contributes a small portion of the total price. The rest is financed, but here's the key detail. The debt is placed on the company being acquired, not the firm, so the company becomes responsible for paying it back. This changes the entire dynamic, because now the company needs to generate enough cash flow to service that debt. Then comes optimization. Costs are reduced, operations are tightened, assets may be sold, or revenue is increased through pricing and expansion. The goal is simple: increase the company's value, not necessarily over decades, but over a defined period of time, usually between 3 and 7 years. During that time, performance is improved, financials are cleaned up, margins are strengthened. Then comes the exit. The company is sold to another firm or taken public. If the value has increased, the return is amplified, because the initial equity investment was small relative to the total deal. That's the effect of leverage. It magnifies gains, but it also shifts risk. If the company underperforms, the debt still exists. And it sits with the company, not the private equity firm. Private equity doesn't build companies from zero. It acquires existing ones, repositions them, and exits at a higher valuation. The model is not just about growth, it's about structure, timing, and leverage. If you want to understand how financial systems use leverage to scale returns, subscribe. Next, we break down why real estate is one of the most common ways individuals use leverage to build wealth. This is Money Mechanics.